chair for the session. My name is Tim Holly and I'm with Agriculture Victoria and I manage the Revenue Value Chain program and the feed program there. My role today is to introduce our presenter, Paul Deane. Paul works for Agriculture Victoria and manages the Livestock Monitor project, which has been a long-term analysis of farm performance across Victoria. And he's worked in the finance industry and has been an analysis in agribusiness and the commodities industry in the past. The presentation will go into where there's the sheep and cattle farming sector perform over recent times and how does it stack up against some of the other opportunities that are out there. And now I might leave it to Paul.
Thanks, Tim. Good afternoon, everyone. It's good to be here, and look, I think it's a really exciting time to be talking about investment in agri, particularly in sheep and cattle businesses, given the way prices, particularly the last few years, have performed. Look, it's always I think an interesting topic, but I can tell you right now it's probably never been more topical than probably the last 3 to 5 years, how agri performs as an investment. I've seen it in past lives, plenty of interest still in foreign investment coming into Australia, not just in agri in Australia, but certainly globally. And even, I guess, domestically on the investment side, still plenty of super funds, some which have been probably a little bit late to the party, looking at agri as an investment, how it stacks up, whether they should be involved. It's really an exciting time and I think interesting time to be talking about it. 2 questions today I want to cover off on. So how has sheep and cattle farming as an investment performed over the last medium term? And I guess relating to that, how does that stack up compared to other investments or other asset classes? What's available elsewhere in the community? In the economy? And the second one is getting into the, I guess, rubbing the crystal ball a little bit about future investment. What does different farm performance, if anything, mean for how perhaps you should be thinking about where you put, as a manager, put capital either on the farm or outside? So they're the 2 questions I want to talk about today. So starting off, just so we're all on the same page, this notion about, how do we measure performance and why? What do we measure? If you cut to the why, look, and we all want to know this sort of thing. Who's a good pilot? All right. So this notion about by measuring performance, we can actually work out who's a good manager, who's doing a good job. And I like this image as well because bear in mind, you can see there they're all different size planes. All right. So the difficulty becomes when we start to think about performance. Your businesses are all different stages, different asset bases. So how do we actually, measure what's a good job in that regard? There's plenty of technical, ratios and efficiency or numbers in your business that, genetics, pasture performance, wool cut per head, per hectare. There's all those technical efficiencies, but from an economist's perspective, they don't always necessarily relate to profit. All right, so I guess what we're trying to look at there is those technical. What I'm talking about today is then on the profit side and economic performance. Again, you get a lot of different numbers thrown at you there. You might be looking at gross margins. Your accountant on a cash basis might say you've made some money. We're looking at it from an overall return of the business, and some of those things, I guess, are important to those non-cash items. So things like a true cost on your labour as an owner-operator in the business. We want to make sure we capture those sort of things. Changes in inventory in livestock, hay, grain as well can also influence profits when we measure that. So we look at whole farm profit and then that's useful. But again, you've all got different asset bases. So we look at total farm profit divided by total assets, gives us our return on assets. So that's really a key measure when we think about financial and economic performance. And the beauty of that number as well is it allows you to better compare across farms and also across asset classes. And so there's, from an investment perspective, again, that return on asset number is a key one that we're talking about. when we think about performance, the other thing I just want to touch on quickly is time frame. I like to show this. This was a study done by Standard & Poor's. They do it every year. So they basically ask the question, they take all the active investment funds in Australia, and there's about 730 in this instance in 2015. And we take the top 25%, right? And they want to say, well, what's the ability for those funds to persist for the next 2 years in the top 25%? Right, so I'll ask you that question now. Just come up with a percentage in your mind. What do you think, what percentage of those funds actually can persist in the top 25% for the next 2 years? And if you got that easy, then what's the ability for those top 25 to stay for the next 4 years? What percentage of those funds? So there's only 8% of those funds in the top 25 could stay in there for the next 2 years in a row. And for the next 4 years, it's only 1%. And the reason I like to show this, you know, those investment funds, I can tell you, are a lot more, and the environment they face is a lot more similar than what farming does. So, you know, the ability to measure performance when we talk, you have to be very careful when we talk about time frame and saying, and for example, grabbing a snapshot of the top 25% of farmers in 1 year doesn't necessarily mean it can be just come back to you know, a bit of luck. Is farming the same? I can tell you, no, it's not. So at this point, the Livestock Farm Monitor Project, which is what I'm involved with. So for a number of decades, Agriculture Victoria, every year, we do an economic, financial, detailed analysis of sheep and cattle farms, and we look at the performance of those farms. So this was some work done a couple of years back by a predecessor of mine. But I mean, to cut to the chase, only 2% of farms, when you look at the ability to make the top 20%, only 2% of farms could stay in the top 20% in 3 out of 5 years. 2%. Right? So, yeah, I've seen plenty of benchmarking, plenty of examples where we're trying to extrapolate what the top 25% are doing in any 1 year and saying that relates to technical efficiency. So, again, time frame, when we start to think about this stuff, becomes very critical. That chart there, that's quarterly average wool prices, and it seems like probably a bit while ago now. But the reason I throw that up is, again, when we talk about performance across any 1 year, you know, we tend to think price sort of levels itself out. It's not such a big issue intra-year. It just depends on the volatility. And so sometimes when we look at, again, this notion of top 25% performance, it can be just luck of the draw on price. So in that the last year, 2016-17, you know, if you just happen to be shearing in spring versus autumn, which tends to dictate largely when you sell, you got $16 a kilo for 19 micron. If you're an autumn shearer, you got 19, right? So they're long-term decisions. It wasn't necessarily, it's going to work on the flip side if prices, which hopefully we hear from Robbie Herman later on, aren't going anywhere. But again, so just be careful, really careful about when we think about performance. Got to make sure we're looking at it from a longer term perspective. All right, so to cut to the chase on all this, how have sheep and cattle farm performed? So again, return on assets, I'm measuring it over the longer term. And what we see is over an 8-year period, and you can see that chart there shows you the performance by different regions. So we break it up across the north, south, west and Gippsland, what return on assets for different businesses have looked like. There's a couple of good years in there, so 10, 11 and 16, 17, quite good. So average 3% return on assets. How does that stack up? Well, you know, it's around the yield, for example, on cash or term deposit, all right? What's interesting when we, again, not looking at if anyone's made the top 20% in any 1 year, but if I pick out the top subset of farms that have actually performed really strongly on an average return on assets basis, they actually could achieve more than double that. So they were achieving a bit over 6% return on assets. So that's the reward when they get it right. You can actually achieve more than double the return and yield on your business. Thank you. It's a great segue. Yeah, so no, to answer your question, so the question was, does that include capital gains? No, so return on assets is a return to your farming business and those assets. So it's not the capital component which we're adding in now. So if we look at the capital gains component of returns, and that's in the orange there if you look on the left-hand side. So over an 8-year period, capital growth in what we measure has been around that 5 or 6% per annum. So straight away you go, return on assets was 3%, capital's 5 to 6. So the capital story, as has been for a while, you know, predominantly when we think about agriculture, the capital component is still being the main game for the average farm. So I guess that's a pretty key message when we think about it. You'll see there on the left-hand side, the top performing farms, similar capital growth, but with as much more than double the rate of return on assets. So they're up to 12% return on asset. Again, that's every year over the last 8 years as an average. So again, as an economist or investor, the way we think about it, how does that stack up against alternative investments? So the way we tend to think about investments returns, okay, we've got return, but we've got to relate it to risk, okay? And so on the vertical there, we've got gross investment returns. So for the average farm, you'll see there in the yellow, around 8%. And then the volatility of those returns. You can see there's a couple of different asset classes in there. So bonds, equities, Australian equities and global equities. So we tend to see that fairly standard relationship where if you're going to take a bit more risk, you expect a bit more of a higher return. The good news there, you can see agri actually, even though perhaps not quite as high as what share returns have been, but you'd argue neither's the risk necessarily and the volatility around those returns. So it actually fits quite nicely that as the ability to generate wealth and actually have your money in sheep and cattle farming has been as good as any way, certainly, to as a way to generate wealth within the family business over the last 8 years or so. So to stick with that sort of same idea, I'm going to add in what our top performing farms look like. And again, it's a very small subset, so we have to be a little bit careful. Too many generalisations, but it's pretty exciting when you look at it from an investment perspective. So there's 5 farms in that group. So I picked them out again because they're all high long-term average return on asset performing businesses. What's interesting when you actually aggregate those 5 businesses, there's 2 in the southwest, 2 in the north and 1 in Gippsland, just as a bit of background. And those overall, they're averaging 12%, but the actually volatility of those returns is lower than actually the average. And so on our risk-reward matrix, you can see there that, again, the real opportunity and prize, there's a really positive story here from an investment perspective that if you get farming right, the ability to generate, good returns without necessarily taking more risk, I think is a really positive story as well. So this notion that we get that, farming's risky, and it is, but what it's showing, I think, is that, again, the ability for good managers to manage that risk, and it doesn't necessarily show up in the volatility of returns. So I showed that to a super fund. They'll definitely want to know who the top 10% of farmers are that can deliver that and what they've done to achieve that. All right, so that's the past. The future. How do we think about the future a little bit? Well, I guess the first point is those average returns don't necessarily tell us much. It's the past, but when we think about it, it's the ability to deploy the return on the marginal capital, all right, that you put in the business or an alternative investment. If, for example, you put money in buying land, it's not the average cost that you would use because you don't, for example, we might have the overheads that you bring across into that. So it's when we think about the return on assets from marginal capital, it's the return from additional costs and additional income. So it doesn't necessarily matter whether you're only achieving average returns or below average. In fact, if you argue if you're below average, maybe the farm has been underinvested in a little bit, there's probably an even greater opportunity to generate above average returns. The other one, of course, is your goals and where your business is at. And I'm not here to say, go and put all your money, reinvest it back in the farm. It does depend on what your motivations are and where your business is at. So, for example, Future One there, so cash or FMDs, great way to de-risk the business, but it's going to be a drag on returns, obviously. All right, because there's no capital growth component in there. You're pretty much guaranteed you're only going to get 3% over the next sort of 3 to 5 years, depending on what interest rates do. So, equally, future four, again, if your aim is to perhaps have similar returns, but you want to, again, de-risk slightly, there's that portfolio theory where moving some of your assets off farm, something like, equities or an alternative asset, you might get a similar overall return, but because those farming and equities tend to be, not as well correlated, there's a bit of a free kick there as far as de-risking your overall investment returns, but not necessarily. And future two, which I guess is what we're talking about and why you're all here today, the ability to generate margin by investing in the farm on a range of things, whether it's soils, pastures, technologies, genetics. Maybe it's infrastructure, the ability to increase labour use efficiency. There's some really high potential returns within the business there. We'll jump you back to this standard sort of risk-reward chart. There's plenty of case studies that when we look at an individual farm basis, and again, you've got to do the analysis, but the ability to deploy marginal capital in your farm, there's plenty of opportunities to create 10 or 15% return on assets by what I've called intensification in this business. In this instance. So if you think of your on-farm alternatives, intensification, i.e., investing maybe in pastures, all those sort of things to increase stocking rate, intensification, or the other one's expansion, so i.e. buying land. They're your two sort of main standard options we tend to think about it from a farm biz perspective. But again, looking on that risk reward, that's the sort of thing that is achievable. I've seen plenty of examples when I look at it on a farm case by case basis that where you can sort of get those sort of returns and marginal capital. All right, so bear with me a bit. I'm going to put on my old finance hat a little bit here. So I quite like that title. We can't remember the future, so we have to imagine it instead. All right, so again, thinking about the future, and I guess one of the things that I'm certainly aware of, and it's not just me, there's a lot smarter people around the world grappling with this very same thing. What do future returns look like for investment across the board when we've basically had 30 years of declining interest rates, which supports asset values and capital values, when that comes to an end? So I'm not here to say interest rates are necessarily going up, but the ability for interest rates globally to go any lower when they're at the bottom, pretty much they're at zero bounds. They've started to go up a little bit in the US. What that does for overall investment returns. And why I like to show this is because again, I promise this is the last one of this chart like this on risk reward. But again, what we've just been talking about, you can see in the red circle there. Again, that's when you're deploying, you get some deploy capital well on the farm, that's 10 or 15%. We've got what's happened over the last 8 years as far as alternative investments. But what does the future look like and there's plenty of people, previous future fund chairmen in Australia grappling with this very same issue. Everyone's concerned about, have we got the ability to generate the same sort of investment returns of what we've seen over the last couple of decades when we've got this, where this tailwind of falling interest rates isn't there. All right, so again, I'm not here to predict that investment returns will be lower, but potentially that future curve for returns for alternative investments, including farming to an extent, because again, there's that capital component in there. So, it's across all asset classes. Any asset class that has had a capital component is likely to see potentially slightly lower returns than what we've seen. So again, using history as a guide. But why I like to show that is, again, the opportunity and the ability to actually, you can see the gap potentially could widen between what you can do and get some 10 or 15% good returns on farm, if you get it right, versus putting your money elsewhere. The gap actually could well be wider in the future. So the ability to actually generate wealth and grow it faster than what's available elsewhere, could there's a real opportunity, I think, there to think about that in terms of your business and that ability to intensify. And again, it depends on, I'm not here to say go and throw money, at willy-nilly in the business. And equally, you've got to, sometimes it means, and first to acknowledge, there might be more management, might be higher risk. So you've got to have all those things lined up as well. But the rewards are certainly there to put capital back in the business, I think, and potentially grow your wealth faster than what you might have with alternative assets over the next period. Anyway, no, I didn't show you that, given I've been talking about the future. We don't have time to. So look, just to sum up, so return on assets when you're thinking about your business should really be a key way to assess it, and again allows you to measure that against, perhaps what other farms are doing easier, and also what you might be able to achieve elsewhere in the economy from an investment perspective. 3% for the average farm, but when you couple that with that capital result, is certainly well up there compared to other investments, which is good. And again, going back to that small subset of farms where they do get it right, the rewards are even greater. So there's a real opportunity and prize there in farming when you especially get it right. And again, that relates, I guess. So there's no question those farms that are at that point have probably been doing that investment on farm and doing it well for potentially a number of years. Again, talking about that subset of farms, to give you an idea, as I said, 2 in the southwest, 2 in the north, 1 in Gippsland. The average age, 4 out of those 5 farms, the owner is in that sort of 45 to 55-year-old bracket. So again, the way they've honed their craft over the last, on the farm. They know it well, and again, they've been employing capital in all the right areas to get it right. I'll paraphrase, but come back to me if I leave any bits out. It's a good question. So the question is around how does, I guess, farm size, economies of scale, how does that influence performance? And when we think about it, where those businesses are at. And look, again, those farms where they're at, I can tell you they've done all that expansion. They've been investing in the farm as well at the same time, but there's no question they have the right economies of scale. So again, this idea that they've had the business is 10 or 20 years in the making, but they've screwed down their overheads by expansion, all those sort of things. I'll give you an example. Those farms' overheads, the average is around $100 a hectare in overheads. There's about $50 a hectare maybe in in owner-operator on top of that. But the range of overheads across a livestock farm monitor project ranges from about $50 a hectare through to about $400. Now, so there's quite a diverse range. Look, the average capital in the farm business that we measure is about $8 million. So that gives you some idea on what the average is. They range from sort of $1.5 million through to well north of 10 million. But they've certainly got a lot of those sort of. Doesn't mean you can't, with scale, you can't achieve decent returns, but if you've got the right scale and economies of scale in your business, it might be worth maybe 1.5% on return on assets. It can be as much as that. It gets very hard on the flip side if you're down to if your overheads are $300 or $400 a hectare. It's very hard to get sort of any. You can't expect to get anything but sort of average or below return. So there's certainly some of those things on the structure of the business and where it's at that influences those costs, which is important. Sorry, just one more point on labour use efficiency. Again, we see a really strong correlation with labour use efficiency and those businesses that perform quite well. Again, that relates to a number of things, and it's partly again about scale. They've got the managers looking after, or the owner is looking after, quite a decent sized farm, which means his overhead or the overheads of the business are lower. But on a ballpark basis, look, there's plenty of good performing farms that are in that 6,000 to 9,000 DSC per labour unit. So that's all labour units. That's owner operator, permanent staff and casual staff hours, which we... Yeah, it is. Yeah, so we add up time basically with all that sort of contractor labour as well. So it's across per labour unit. Yeah. So, but again, a large chunk of that comes from the ability to have scale and be managing a decent number of livestock.
Question from James. Thanks, Paul. It seems to me that more often than not, the thing that separates the top 20% producers is income per hectare. That's what seems to take them to the next level. I was just wondering if you had any comments on that.
Yeah, it's a good point, James. So if you look at the analysis, good. Thanks, Tim.
I was loud enough.
So the question was around that the driver is for farm performance is income rather than costs. Is that a fair assumption? Yeah. Certainly. When you do the analysis of performance, variable costs tend not to matter too much. Although the only thing I will, when we start to look at farms that are performing well, what we actually do see that one area on a variable cost component, they actually spend above average in pastures and fertiliser. So that's the only area they actually spend above average on. So they tend to be on all the other shearing, all those sort of vet expenses. It tends to be actually maybe slightly underspend on, but there's not a lot in it. But what's interesting is that and again, these are businesses. Even though you would have thought they've put a lot of capital into their soils and done all the right things over time, but yet they're still overspend or spending right up there on the average with putting inputs in pastures and fertiliser, etc., and lime and things. I don't know. Sorry, I probably only half answered your question. To go back to the other, and you're right, on the income side, certainly, we see more variability on what drives income. And again, it's nothing new there, but you come back to that, it's about wool cut per hectare is a pretty key. So, I guess from an economist, we're always looking at it on a per hectare basis, per heads. It's important, but that per hectare is a key driver, whether it's lamb output or wool output.
Authorised by Victorian Government, 1 Treasury Place, Melbourne.